Larry, appreciate the time. Good to see you again.
Good to see you. Thanks for having me on ahead of such an anticipated meeting.
Yeah, no, it's interesting, and a lot of commentary over the weekend. I know Goldman thinks that the median dot will start to approach 4.5, and their general point is that FOMC participants are not going to want to forecast any cuts after begging the bond market to stick with them back in August. What do you think?
Well, we've been at 4.5 as a terminal rate for some time. However, we do think that in 2024, 2025, there will be cuts because we're in a growth recession. The unemployment rate is going to rise quite a bit, and there is a danger of falling into a full recession.
What's your sense of the progress they've made so far? I mean, financial conditions are maybe even tighter right now than they were back in June. We just got some pretty bearish housing data. We know what the stock market's done. I mean, but we continue to see robust employment and jobless claims that are suppressed.
Yes, that's true. The labor market stands out. If you look at growth, it slowed down as you would expect. Below trend, we'll see rising unemployment rate. We have this divergence from the labor market, which is a little hard to explain, but certainly I believe the labor market will adjust to growth and slow down into next year.
So, Larry, it's Morgan.
Go ahead.
Mm-hmm. So then what matters more to the Fed now? Is it the inflation data, which we know is lagging, especially when you're talking about things like housing data in CPI numbers and PCE and whatnot? Or is it the labor market and the readings we're getting there?
It's all about inflation, whether it's wages or prices. That's the priority. Unacceptable 40-year high, that's all that matters right now. And if the economy slips into a growth recession, fine. If that's what it takes, a mild recession if necessary, whatever it takes, you've got to get that down towards 2%.
So at what point then, if we are looking at more recession, maybe the hard landing narrative as opposed to a soft landing, when do the doves start to speak out?
Well, I think at this point, I wouldn't see a hard landing. A mild recession is an unemployment rate maybe approaching 5% from 3.7 today. You know, a hard landing would be more like 6 or 7%. Now, I don't see a hard landing. I don't think many do, but it's always a risk. Now, as we go along, this notion of the dual mandate and the view within the Fed that you need to go slower or you need to stop, that will be more of an issue. And you could have dissents, but we're quite a ways from that. We haven't seen this persistent inflation begin to even decline. So nobody is thinking about that right now.
Well, when do you expect that we're going to start to see this persistent inflation decline? Do you have a sense as to when we're really going to get consistently lower numbers?
Well, you know, at the beginning of the year, I would have said the second half. Okay, now we'll say the first half of next year. We should see a meaningful decline in inflation. And it's very complicated because it depends on how much this inflation is due to the demand forces and how much the supply constraints. If the latter, it's going to come down kind of on its own. And that's what my forecast, and I think that's what the forecast implies for the FOMC. If it's all demand, could have a deep recession.
Shepard Smith here. Thanks for watching CNBC on YouTube.